Hello Propenomix people, and apologies for not being able to get this recorded over the weekend, but I wasn't able to get any internet of any reasonable quality, so even if I had recorded it, I wouldn't have been able to upload it. But this is my Sunday supplement from the 14th of April 2024, and it is titled An Alternative Perspective on the Rental Sector. So you'll know that I like to start with a quote, and this week's is, "The optimist sees the donut, the pessimist sees the hole," and that's from Oscar Wilde. So before we crack on, some exciting news about the 27th of April. It's the first in a series of in-person social housing events that Partners in Property are organising. There are 7 speaker slots covering every aspect of social housing, and the objective is that attendees will be able to walk away with all the nuts and bolts they need to decide whether to incorporate social housing within their own property portfolio. The agenda is going to include why Sue Sims started in social housing as an investor more than 8 years ago. It's going to have Wayne Millwood, the founder of Room Match, outlining all the due diligence you need to undertake when deciding which social housing provider to work with. Mark Turner, the COO from the Housing Network, who's going to be talking about the future of social housing. A social housing expert mortgage broker, confirming exactly what you need to provide and take into account when you're looking for funding for social housing. And also Pinder, the MD from Falcon Insurance, who's going to give you an overview of how to insure your property that is leased to a social housing provider and not leave yourself exposed or underinsured. There are still a couple of early bird tickets left, and the link will be in the chat. I'd also just like to share, we've got 1 ticket left for our property business workshop that's going to be next week, myself and Rod. So that's Wednesday the 24th of April. There's only 1 left genuinely. There's not going to be magically 10 other tickets that appear. We've got to our maximum capacity, which I'm really pleased about. Just want to sell that last ticket because I'm competitive. So if you haven't bought one yet, bit.ly/PBWTWO. Thank you. Now, welcome to the supplement proper. And obviously, we've got Easter out of the way. The macro news kicked right back in, and we had some tougher consequences than March's news as a whole. When it appears I've been right about something, I do have 2 competing feelings. Firstly, self-validation. Of course, I'll accept ego if you prefer, although it gives me no sense of satisfaction or self-fulfillment other than to remind me that the work and the level of work and dedication I put in to being a better forecaster than the financial or economic press, and often the market. And then the other feeling I get is a bit of moroseness to an extent, because at least 50% of the time in the past 12 months, it seems my predictions have swayed towards critiquing the market for being too overconfident. Macro's busier week was definitely not all happy talk, although 1 week is just that. There are 13 of them in each quarter and 52 of them in each year. Q1 ended with a bang, nailing down the economic growth we needed. News yet to officially come, granted, and consumption being such a big part of GDP, and quite hard to measure or quantify in real time or in advance, but we've certainly seen that business sectoral growth that we needed. Q2 has not started with the same vigour. I'll remind you of my treacle analogy at the beginning of 2023. Are we back there? Have we progressed since then? Well, we definitely have. We had inflation finding its top and needing a major haircut to come down to anything acceptable. I've said a number of times, the only problem with 4% inflation as a soft target, and actually 3.5 or 3 probably looks closer to the potential truth, is that any inflationary events, especially in an economy which basically relies on imports for its energy, send inflation to 6 or 7% quite quickly, which is again deemed out of control and puts the UK at risk of international investors not taking us very seriously or seeing us as a safe custodian of their money, which we rely upon for our bond market price setting, which in turn sets our mortgage rates. So we're definitely not in a start of 2023 sort of malaise. If anything, the growth we haven't had since January 23 should, with tax changes for the individual, plus the relative stabilisation of yields, which are still around 90 basis points lower than last year's highs, see us in better shape to move forwards as an economy and as a housing market. However, every week that goes on in 2024 brings us ever closer to that election, that freeze in the intentions of the housing market, or at least suppression of activity. What we're seeing is a very close parallel in terms of listing numbers to 2019, which was a flat market, which incidentally we found excellent for trading conditions in terms of acquiring stock. The chief differences are the underlying interest rates, of course, the higher increases wages, which should help drive house prices, the higher inflation, which will drive prices by definition, and the ever more significant lack of stock issue, which cannot help but drive prices. We're down to the difference being but a couple of percent or a few percent in most of those metrics, but all favour of 2024 being a better nominal price market than 2019. Anyway, enough pre-summary. We're on to the macro before I take a closer look at the output from the Resolution Foundation, who've done some work on rents. I'm ever more interested in the output from the foundation because they do, without being overly political, listen, they lean left, but most economists do almost by default. They provide some of the better analysis of what the average worker contends with, particularly, it seems, at the younger ages, which is a fairly good proxy for the rental market in general. A choice of 4 macro areas then. The bond and swaps are inevitable and come as our last anchor of the 4. We can't avoid a conversation around February's GDP figures and the underlying growth in some sectors of the economy. The RICS house price balance needs to feature, and also the BRC retail sales monitor as part of one of our better proxies for consumption. So GDP first, a huge fanfare as we hit the monthly consensus and another 0.1% of growth. But also January was revised to 0.3 rather than 0.2, which is not a massive surprise, as a lot of the metrics that normally struggle in January did not do so. It's a strange consumption pattern that I'm still struggling to get my head around, to be honest, as January is normally particularly lean. Perhaps everyone thought Christmas was going to be terrible and December was going to be a bad month, and they were pleasantly surprised in January. They still had money in the pocket and decided to spend it. I don't know. The 3-month figure then now is plus 0.2%. Services grew 0.1% in February, which seems in line with the PMIs that we observed, and they also grow 0.3 in January after the revision. So no surprise that the revision in services led to the same number being the GDP print, because services are such a big part of the economy. And the services 3-month figure also matches that plus 0.2%. Production output was particularly helpful, which grew 1.1% in February, but construction output was down a pretty massive 1.9% on the month. This is worth a closer look, of course. Much smaller portions of the economy than services, but still significant implications for readers and listeners of the supplement. So I draw one thing out of the services breakdown first: a 3.6% increase in sports activities, amusement and recreation activities over the 3-month period. A sign, I think, that the cost of living crisis was indeed abating significantly from the back end of 2023, as I identified at the time in the supplement. So construction. New work down 3% over the previous quarter. Typical winter, maybe you might say. Repairs and maintenance up 1.6%, again perhaps typically. However, when you look at the breakdown, private commercial new work was down 4% on the month. The weather gets the blame. Well, this is Britain, folks. But in typical ONS style, they do quantify that February in the southern half of the UK, which has the bulk of the construction activity, remember, there was more than twice the average rainfall, and it was the 4th wettest February on record. So perhaps we can park this and expect that to mean delays rather than any real issues in the sector. We'll know in a month or so. On to the RICS house price balance, one of the better temperature taking metrics, alongside looking at the efforts of Christopher Watkin for the real-time health of the retail housing market. It only lags the previous month by a couple of weeks, and so it keeps my impatient nature somewhat at bay. We moved to -4, our best print since October 22, which was in the middle of a cycle where we dropped from +61 in July 22, hot as hell and needing cooling, and we've been around +60 since September 2020, so we were definitely approaching bubble territory, to -42 by the end of 2022. So the second half of 22 saw a 103-point drop in the balance. Bear in mind the top score theoretically would be +100 and the bottom -100, on paper anyway. The lettuce can obviously take a bow for some of that, but not all. She wasn't in charge in August 22, for example. She definitely influenced the speed of that drawdown in that measure, though, because of what she did to the interest rates alongside her partner in crime, Mr. Kwarteng. I've said it a few times this year so far, cautiously optimistic. That's what -4 feels like. Stable, that's a word, still feels wrong to use it after the terrible usage of the strong and stable trope during the limp Theresa May campaign in the election of 2017, but we haven't seen that often enough in the past 4 years. The reading of respondents citing an increase in new buyer inquiries in March was +8%, the best reading since Feb 22. +13 cited new listings, meaning that listings need to stand out or offer good value to sell. +46% expect sales activity to rise over the next year, although it was a limp 2023, so don't get overexcited by this. Tenant demand reads +19. All of these metrics are positives minus negatives, just to clarify. Landlord instructions reads -19. That's a good snapshot of where the rental market is still at. Rents to move up reads +34, so that will be 67% of surveyors saying rents up, 33% saying rents down or sideways. Rix also alluded to the launch of the inquiry into the home buying and selling process, which I'd expect to make some recommendations for improvements. Home information packs or home reports like Scotland. This is, of course, Turkey's voting to eat goose for Christmas, as far as the RICS is concerned, because imagine all the work it would generate for them. So we know what they'll think, but we also do know that the current process is pretty rubbish, let's face it, so improvements will be welcomed. My third choice for this week was the British Retail Consortium's Retail Sales Monitor. They printed a very healthy 3.2%, but be warned, it was largely the fact that Easter Sunday fell in March rather than April. Next month we'll fix that anomaly in the figures. Also, bear in mind, they're not real figures, they're just nominal. I.e., is it reasonable to suggest they just about kept pace with inflation, which is a lot better than they did last year? But understand that retail will be facing more pressure than many other sectors with massive minimum wage increases, as a higher proportion of the jobs are at minimum than in other sectors. And so that total employer cost increase of over 11.5% in April is going to hurt. When you drill down, the only growth is actually in food sales, growth of 6.8%. Non-food is down 1.9%. Online has also not been growing year on year, possibly the last throes of the pandemic shaking their way out of the system. But at some point the pandemic ceases to be the reasoning. It will have much longer shadows in the health of the nation, both physical and mental, of course. The commentary was positive, but overall the sector still looks relatively beleaguered. Those working in it now at a senior level are just used to it by now, I think. Onto our flagship sweat in that case, then the bond and swaps market, and it was a sweaty one. I posted in midweek with my usual loquacious style on one particular social media platform, simply a crying face emoji. There were two incidents of note, particularly this week. The USA missed their consensus figures on inflation by 0.1% on both CPI and core. It doesn't sound like much, does it? But CPI in the US was already expected to rebound from 3.2 to 3.4, and instead it hit 3.5. Core, expected to stay at 3.7, actually went to 3.8. World's still pretending that 2% is the target, of course, but when you owe $34.65 trillion, don't tell me you don't love a bit of 3.5 to 4% inflation. That would be a lie. The US markets therefore hardened on the bond yields, and so did ours. Having mourned 0.1% last week, I think I'm entitled to mourn 0.2% this week. The other incident of note, apart from comparative positivity in the economy, as discussed in the growth figures, the 0.1% growth was expected for Feb, but the revision for Jan was not, was the Bank of England hawks, or the transitionary hawk that is Megan Green. I know you shouldn't have favourites, but she's mine as far as the Monetary Policy Committee goes. Following up on Jonathan Hawke Haskell's chat from before Easter, the soundbite that made it out into the media was that anyone betting on rate cuts in the summer are making bets in the wrong direction, as any easing is some way off. So pretty strong chat, really. The markets now suggest base will be 4.75 by the end of this year. My range was 4.5 to 4.75, but I'm wondering now whether it could be 5 or even 5.25. We'll have to await the CPI rebound after April's print is a known low one. This, however, is where we may diverge a little, and I don't remember the last time I disagreed with Megan Green. Here we go. She said, following surprisingly strong US March CPI, markets now expect that the Bank of England will cut rates earlier and by more than the Federal Reserve this year. Macroeconomic fundamentals and inflation dynamics differ in the UK and the US, and there's a greater risk of persistence in the former. Now listen, I have to say this. She's smarter than me, more well qualified than me, and she has a great handle on the USA as an American citizen. And she's right in terms of textbook answers. I've said it myself a number of times throughout this inflationary cycle. Historically, the UK runs hotter than the US. However, the US money supply increased by 40% in a period of about 2.5 years, during and just after the pandemic, depending on where you end the pandemic on WHO declarations or when you just think it was under control, looking back at the numbers. In the UK, that money supply increase was 22%. UK inflation over that period has now shaken out at around 22.7%. The US is nowhere near their 40% money supply increase number. They're actually at 21%. So that's what a fully paid up monetarist would tell you, and the correlation between the two graphs is rather irresistible to throw that argument out completely. That doesn't even seem to make it into any of the Bank of England's rhetoric. So I'm going to disagree here. The US, as at today, has a much bigger secular inflation problem than the UK does. Doesn't mean the UK doesn't have one at all, of course. But the UK's problem will soon be getting the patient off the operating table, I think. That's what should happen. But is it what will happen? Now listen, wages are sticky. They're unlikely to come down in nominal terms at any point. And the rise in them is likely to persist, is what that means. The price of many things are also sticky, let alone the fact that oil's gone back over $90 a barrel, which influences travel and transportation costs, of course. It's up about 6% on the month. But to wheel out that phrase one more time, the risks remain to the upside at the moment. So, the actual week on the gilts, anyway. I digress there, as I'm wont to do. For the 5-year, our poison of choice, we opened at a hopeful 3.88 and traded up to near 4% in the midweek, but decayed back to 3.9 as we went for lunch on Wednesday. The US inflation figures came out at 1:30 p.m, and so we jumped very quickly above 4%, closing around 4.05. Megan's commentary hit the headlines and we jumped to test 4.15, but closed Thursday around 4.11. The swaps closed Wednesday at 3.964, preserving that near 10 basis point discount to the gilt rate, and expect this discount to continue, as mortgage demand will stay lower on the back of this news. Remember my fair value range, which I'm still not inclined to update, was 3.5% to 4% for the year, for the 5-year gilt yield, with a 0.25% expansion vessel. We're in the vessel again, for the second time to my reckoning, but we have lower inflation numbers coming next week. It's temporary, as I've been saying, but markets too often see what's in front of them in the now, not the longer form picture. And on one metric at least, as long as the money supply is controlled well in the coming months, our pandemic inflation is washed through, apart from the sticky bits. I perversely feel more comfortable about the inflation level. Sure, I still think 3 to 3.5 is a much more realistic target than 2 at the moment, and I still feel the government is delighted with that with all the frozen tax thresholds, but I feel more comfortable with the inflation level than I have done for years. Okay, that's the starter out the way, and this week I want to get stuck into the Resolution Foundation's recently released report, which is talking primarily about rents. This is the future of the sector as we see it, because our price increases, as people who use leverage, have not been 22%. We've faced insurance rises of, you tell me, but I'd say well over 50% and perhaps over 75%. I don't have my collated group insurance data to hand. Maintenance rises are well over 40%. A lot of damage done by properties not being heated adequately during the cost of living crisis, and also by heavy rainfall over this winter season. Interest rate cost rises of more like 80 to 90% on interest-only mortgages, depending on where you measure from. I think if you measure from the end of 2019, 3% with a 1% fee would be fair, I think. Moving to 5.75 with a 1% fee right now. If we price based on today's bond markets, that's 91.7%. So rents up 25% is great for landlords, although nothing in real terms, but it still represents squeezed margins compared to before the pandemic. And we weren't at the golden era of buy-to-let before the pandemic, let's face it. George Osborne had already ended that. The Foundation captures that quite nicely in their analysis. There's a fairly dry but worthwhile recording of their findings, which includes input from Zoopla's Director of Research, Richard Donnell, and a representative from the National Residential Landlords Association. And there's a link to that YouTube video. It's well worth looking up the Resolution Foundation's YouTube channel if you want to go and look at the source conversation. And then there's the fact that existing rents won't be at market level. When you have a 12-month gap between rises, and in a portfolio situation, it's not possible. This is again something the Foundation alludes to in their analysis. And of course, we're coming from two different angles. Me as a portfolio holder and talking to everyone here from an investor perspective, and them as a think tank and social commentator. I do believe, however, that everyone wants tenants to be in affordable, decent housing, and so whilst those rises and plenty more are needed to move back to anything like a functioning rental sector, there are certainly more rises to come when you see it framed like that. The headline from their report, which was entitled Through the Roof, are rents up 13% in the next 3 years as they see it. They characterise the current housing market as not delivering for low to middle income families. So let's get into the summary. The price of a new tenancy has increased by nearly 20% since the start of 2022. I always feel two ways about this sort of opening salvo. This is, after all, a report about rents, so it has to be the focus. However, should it be out of context? How much are wages up since January 2022? 13% the average weekly earnings increase to March 2024. How about benefits? 21.1%, but there have been 3 rises since then if we use the date of the report, as the benchmark. April 22, April 23 and April 24. How about housing benefit or LHA specifically? Well, the average is about 17% in the new increases. So the actual number is 18% rather than nearly a fifth as well, which tells you where the author wants to take us on this journey. In that context, it is concerning that wages haven't kept pace with that, and that's the Foundation's general raison d'etre, working, low-income and middle-income families, so they're rightly concerned. But also we need to focus, of course, on all tenancies rather than new tenancies. I'm also tempted to make the case to throw out the Scottish figures because of the mess of rent control, but they may well already not be in the data anyway. That level of transparency is not available. Anyway, rental prices for all rents are currently rising at their fastest pace on record. That's certainly consistent with the ONS data, their last number, 9%. The report is keen to dispel the myth that rent increases have been forced by mortgage increases, because 38%, according to the Foundation, we've seen higher numbers of landlords have no mortgage. They cite the power of the market as the reason why this should be dismissed. Landlords would already have put the rents up if they could have got away with it, is what they're saying. I struggle with this argument on an economic basis, which is strange when they come from an economic place, usually, in the debates I've seen. It's also quite incomplete as a piece of analysis when you compare the reality of an example that I shared this week. Some of the numbers are somewhat hard to come by, but even if we stick to ONS figures, 34.8% increase in insurance, that's the whole sector, not property insurance, which I'd suggest is up even more, since January 2022. Maintenance repairs, up 17.1% in the same time period. Mortgages since Jan 22, not measured on investment property, but I'd suggest that 91.7% from my analysis earlier on in this piece. Further costs will have been injected in some areas with new licensing schemes that pop up with regularity, of course. I know of no other business where significant increases in the cost of delivery don't push prices up, particularly when that service or good being provided is relatively inelastic, as all the research on the price elasticity of demand for housing suggests that it is. For those who don't speak economist, that means that when the price goes up 1%, the demand for the good or service goes down less than 1%. I've honestly no idea why housing is treated differently, and can only assume that it's an ideological position, which is a word that really shouldn't contain the word logical, should it? The report then moves on to another incomplete piece of analysis, claiming the decrease of 47,000 units in the PRS since 2019, as per recent Bank of England research, which again is incomplete, but recognises this sort of thing just isn't really measured very well. Context is required here. 1.68 million net migrants in that time, who I believe is not really disputed that about 90% of them are likely to enter the rental property market. Perhaps not all into the PRS, for sure. Let's be conservative and suggest only 1 million will rent, and we know the average immigrant household is 1.25 people strong. Many will gravitate to HMO, as many readers will already know, but the number of available HMO units is also falling, according to the thin data that is around. There's a need for a growing sector, not a shrinking or a flat one. There's also no allowances made here for properties that have been let as short-term accommodation, rather than being sold off, because of the way that they're measuring it. They also debunk the housing supply and demand argument, and whilst relying on figures from 2022, which miss out the huge migration figures since then, I'm more inclined to agree with that. Supply is a continual problem that has got worse, but not relatively so much worse that it would explain the rise in rents. To not even consider overall inflation as a significant driver here is madness and strikes me as quite incomplete. My admittedly relatively simplistic argument that everything is up 22% since the pandemic fits Occam's razor perfectly here. The answer is already in front of you. Getting tied up in the political side of it, or addressing the points that no one else wants to for sensitivity reasons or whatever, is, to me anyway, the obvious omission. They prefer to focus on earnings, which again is their raison d'etre. There's no discussion of the correlation between earnings and rents, and whilst it's self-evident that affordability is a critical factor, it would still be good to understand that correlation. The more interesting, but again omitted point by the Foundation, is that they display on the graph I've included for this week a falling trend in terms of rents, but they don't challenge why that is, and indeed why that should be. I've been referring to this since uncovering the data back to 2005 last year, and it seems that the Foundation have got data back to 2000. Should rent be falling over time as a proportion of earnings? It's great if it does for the people as a whole, but if you damage the sector with hostility and taxation, as has been the case since 2015, What would the expectation be? Surely to drive people out and reverse that trend. There's no reasoning explored for the direction of the trend line, and that leaves a lot of questions unanswered. However, in the interest of moving forward and finding some common ground, because all I'm doing at the moment is finding fault, even though the research definitely has some positive merits, let's press on. Regardless of questions around the trend line, rents were 5% or so below the trend line at the start of 2022. So the move has been above the line since then, of course. The argument is from the foundation that part of the movement is a correction, and that's a sensible argument, even if I disagree with the premise of a linear relationship downwards since about 2016 when things really started to change. So we're at 5% below the trend line, then plus 18% in the face of 13% wage increases. That's basically smack on the wage trend line then, isn't it? -5 plus 18 is plus 13. So the report also recognises the folly of looking at the new tenancy prices, which affect about 22% of tenants every year. And although I would again dispute the exact logic used, one cannot deny a lag effect on existing tenancies, where rents will most likely continue to rise for the reasons I've stated in terms of cost of delivery mostly. Even the 38% or more of unencumbered landlords will have seen larger than inflation increases in their other costs above where their existing rents have got to in the time period, and they're still catching up. They borrow the US results, which is something I have sympathy with, where rents are now increasing more for existing tenancies than they are for new tenancies. They don't need to. The Zoopla or HomeLet data as recently analysed here is moving more slowly, 7.6% averaging the two, than the ONS figure, which is 9%. Strip out the new tenancies and that gives you an existing tenant rise of 9.4% over the past 12 months. They predict 4.2% rent growth over the next 3 years on average. I'm above this because I'm above the inflation predictions in the market still, although I'm no longer as far ahead of the pack as I was in 22 and 23. I'm just in the top 10% of the forecast now, rather than ahead of every other forecaster that there was. The report recognises how difficult it is to measure private rents. Since they're now so important politically, much more effort is being made by the ONS and the Bank of England. And we've discussed this before, so I'm going to leave that point there. The report also makes one of the worst parallels between rent and homeowners I've ever seen. It quotes 33.8% of renters' income on housing costs versus 10% by the average mortgagor. It excludes the capital repayment element, which is not optional for homeowners these days. It always excludes the alternative returns that could be achieved by investing the deposit for the house elsewhere. It excludes insurance, maintenance, let alone improvements, compliance costs, and the likes of which you become responsible for as a homeowner, but the landlord has responsibility for in a rental property. It also leaves out that the average renter's household income is around 30k, whereas the average owned household's income is around 60k. Inconvenient, I know, but surely it should be mentioned. The data is also extremely outdated, ends in 2021, when since then mortgagors have taken gigantic cost increases or are facing them when they come to renewal. The biggest concern for me is that the net flow of properties into and out of the private rental sector, as per this week's graph, is just so obviously wrong. There is no way the sector is changing by such a small amount, or has changed by such a small amount in the past 11 years or so. I share it because it's the best data we have available and the methodology is not bad and better than the rest, but it's still very weak. It needs a complete overhaul, and that piece of work is one bridge too far for me on my own, I fear. I dislike throwing stones without a solution, but I hope the report gives you an idea of what the sympathetic left are saying about the housing situation right now. And it also challenges a few of the assumptions which have limited logical bases within the report. Congratulations for getting to the end. Don't forget the Property Business Workshop on the Wednesday the 24th of April if you want that last ticket, or for anybody that you know is at bit.ly/PBWTWO. Other than that, onwards and upwards as we press through Q2. Just remains to say, keep calm and carry on.